Hello, this is Chad Lubin of Cross Country Mortgage. Welcome to your weekly market update. So last week we had a big event. I will share the charts with you. The Federal Reserve Board decided to increase the federal prime rate by 0.75%. So they've done 150 basis points within the last two sessions. So you can see on July 21st, we've had a big rally since that time. So interest rates improved about 0.5% from here to yesterday. As you can see, interest rates bottomed out. So the thing about mortgage bond trading, that's the chart I'm showing you. The higher the price, the lower the interest rate. So please don't get it confused. Federal funds rate is short-term interest rates. What drives mortgage rates is how traders react to the news out there. Remember, it's just like the stock market, mortgage-backed securities. They're looking 6 months to a year ahead. They're trying to predict what the future is going to hold. So the number one enemy of mortgage rates and long-term interest rates, think a 30-year fixed mortgage, is not the Fed increasing the prime rate. It is indeed inflation. So traders took this as a great sign that the Fed is getting serious about containing inflation. And remember, inflation is the cost of goods increasing. So we did, as you can see, I want you to know how much of an expert I am, my team captain Derek is in these markets. So as you can see, we locked in interest rates here on July 28th, right? They got a little bit worse after that. They did get just a touch better. Yesterday was the lowest rate we have seen since May 27th. We locked in many of our clients' loans. So check it out. People that are under contract with us went from having, call it 5.5% interest rate down to a 5% interest rate. So just be cognizant of that we are experts in this. We float the markets perfectly. And we know these markets. I've been following them for 20 years. I have a finance degree. So that's the first thing I wanted to show you guys is interest rates have improved. We're now about 1/4 to 3/8% better interest rates. And you've been seeing the last few months. Second thing I want to show you. There's a lot of misinformation out there right now. So if you see this chart here that I'm showing you, this is what foreclosures have been dating back to 2008. So obviously during the financial crisis, you can see the peak of foreclosures was 1.65 million. That's astronomical, right? The average equity at this time in a home was 13%. So you're starting to hear the media spin this. They are indeed correct. Foreclosures have went up 150% since last year. But you have to remember there was a moratorium of in 2020 of allowing people to not pay their mortgage payments due to COVID, right? That kind of continued into 2021 and a hot market. Remember, if someone was struggling paying their mortgage, they could sell their home, make money, and get out. They can still do that in this market. This was an all-time low. So what you're starting to see, guys, is a return to a normal market. If you look back and just look at history always gives us the answer. 2019 was a very normal market. We made good money. I know a lot of my top realtors made good money. I know a lot of clients made very good money. I sold a property in 2019, right? We're still way below the foreclosure rate of 2019. So don't let the media spin you. Don't let the media spin your clients. They spin this. Their job is to get eyes. And they're spinning this as, oh my God, foreclosures are up 150%. Yes, that is true. But look back pre-pandemic, right? This is about half of what a normal market looks like in foreclosures. And here's the reason why foreclosures are not going to become a problem. The average loan to value ratio, meaning mortgage compared to home value, is 42%. So if you subtract that from 100, there is 58% equity in the normal person's home. That's an all-time record high. And when you compare that to 2010, when it was 13%, people aren't going to leave that money on the table, allow their foreclosure to happen, and have the bank capture all that equity. It's not going to happen. So we're in a very normal market. CoreLogic just predicted, and I agree with their assessment, about a 4.5% appreciation from July 2022 to July 2023. And what we need to remember is that on a $400,000 home is $16,000. Let's say you put down 10%. That's a 40% return on your money. So we got to look at the return on investment and leverage the mortgage to get a high return on our investment. I invest a ton in the stock market. I invest a ton in crypto. I invest in real estate. That type of return beats anything I've got long-term within the stock market. Now, are there a few stocks that have outperformed that over time? Sure. Apple's done 100% for me, Amazon, but when you spread across your risk, across all the stocks, the wins and the losses, real estate almost always wins. Leveraging your home purchase with a mortgage, and the less you put down and the more appreciation you have, the better return on your investment. Guys, we're just going to be paying someone else's mortgage if we're not a homeowners. I've been a landlord for 15 of 20 years of home ownership. I've had rental properties. I don't pay anything to keep that property going. My tenants pay that for me, right? I make money off the rent. They pay down my mortgage. I end up selling it and capturing all that gain. So remember, when you're renting, you're always paying someone's mortgage. Why not pay your own? Why not create your own equity? I believe interest rates will continue to decline as they have the last 2 weeks. Now, will it be linear? Will you see it just go straight down? No, you're going to see times like I just showed you where rates come way down and then they pop back up, then they make a move down. So markets are not linear. They're very volatile, and we are the experts in helping you navigate this. If I can help you in any way, please give our office a call. You can get on my schedule with my team to discuss any of these topics. 312-731-4939.